Here's our video lecture for chapter number 9, where we have two topics. In this video, we'll cover estimated tax payments, and then in the second video, we'll talk about retirement plans. Here's a listing of chapter objectives for chapter number 9, and we're not going to cover all of them in detail. For example, income tax withholdings, or FICA taxes, that's Social Security and Medicare taxes, or federal unemployment tax or state unemployment taxes. All of those taxes are covered in another course called Accounting 132. That's payroll accounting and Hawaii general excise tax. Our tax system is a pay-as-you-go system where as you earn income, you got to pay taxes at the same time. And you cannot wait till after the year's over when you file your tax return and pay all of the taxes. For example, in the case of wages or salaries, your employer is going to withhold income taxes from every paycheck. That's also similar for retirement pay. Maybe even Social Security benefits as you collect, you can ask the government to withhold income taxes. But for taxpayers that have income that's not subject to withholding, they have to pay taxes on their own. For example, we learned a few chapters ago, self-employed taxpayers, probably filing a Schedule C as a sole proprietor, or even partners in a partnership. Or for example, last semester, for landlords with rental income, they may have to pay taxes on their own, and that's called estimated tax payments. And typically it's paid 4 times a year, almost quarterly. We'll see the due dates on the next slide. And then the rest of the course chapter objectives here, we'll cover that in the next video for retirement plans. So here's the general rule for estimated tax payments. If you don't pay taxes during the year, and you should have, you may be penalized. The penalty uses a percentage of 5 to 6%. So if you're underpaid during the year, not only do you have to pay income taxes for the balance you still owe, but the government may charge you the so-called late payment of estimated tax penalty. Now there's exceptions to the penalty. One of the exceptions is if you owe under $1,000 for the year after taking into account withholdings from your paycheck or retirement pay, and also subtracting out any timely paid estimates you've already made during the year. And again, if you owe less than 1,000, then there's no penalty. You just pay that balance when you file your income tax return by April 15th. Now, estimated tax payments typically are paid 4 times a year, and you can see here roughly the due dates. Yeah, not quite quarterly, yeah, but these are the official due dates. You gotta make those 4 payments by. And notice this first quarterly payment. It's the same date that's the due date for the previous year's return. So if you have a balance due for last year's return, you got to make sure you have enough money to make this first quarter payment for the subsequent year at the same date. So it's sometimes a big hit for a lot of taxpayers, this April 15th date. Now, besides this under $1,000 exception, there's a couple or 3 more exceptions. Here it says that if you've paid 90% of the taxes that are due for the year timely through withholdings or through timely quarterly estimated tax payments, then there should be no penalty. Again, you just make up the difference when you file your tax return after the year's over. The thing about this current year tax is that you have to be making payments during the year. And during the year, you may not know how much is your current tax for the whole year, right? Here's the first year, April 15th, and you gotta make sure you make at least 1/4 of 90% of the tax. But what is 90% of the tax? What is 100% of the current year? Because the year's not over yet. So sometimes it's hard to guess, hard to estimate this exception of paying 90% of the current year through withholdings and estimated payments. An easier way to pay estimated taxes is to take a look at the previous year return, here called prior year return. And as long as you pay 100% of last year's total taxes for the current year, then you have what we call let me spell it out here. They call this a safe estimate, safe estimate tax payments. Not by estimating the current year's payments, but you look at last year's total taxes you owe. And as long as you pay 100% of the tax this current year, based on last year's tax, you have a safe estimate and there's not going to be any estimated tax penalty. If you still owe money, could be more than 1,000, you just pay it with your income tax return when you file it by April 15th, and you won't be charged a penalty. Now, all of these three exceptions we just talked about, under $1,000, paying 90% of the current year, paying 100% of the prior year, the IRS already knows these calculations, these amounts. So if you meet any of these three, the government won't charge you a penalty. Now, if you don't meet these exceptions, the government will automatically send you a bill for this, again, late payment of estimated tax payments. So if you think that you don't owe a penalty based on another exception, which is this one down here, then you may need to file a form to show how you meet this exception. Okay, so let's say that, well, let's go back to this one here, this 100% of the prior year. Okay, so for most people, this is what they do. They use a safe estimate. They take that prior year tax and again divide it up by 4, and they make 4 monthly payments. That's not counting any withholding. If you have withholding, again, you take 100% of the prior year minus out last year's withholdings and divide the balance by 4, and you make 4 payments on these dates here. Here there's an exception if your adjusted gross income for last year is over than 150,000. Then instead of 100% of last year's taxes, you have to take 10% of last year's taxes. Let me give you an example. Let's say that last year's taxes was 20,000. So typically, if your adjusted gross income was under 150, you just divide this by 4 or get $5,000 for each one of these 4 payments you have to make for the current year. But if last year's taxes were, last year's adjusted gross income was more than 150, then the safe estimate is going to be 10% more, or 22,000 for the whole year. Again, divided by 4. So each estimated tax payment is now 5,500. Okay, so again, you can reduce this total taxes here by any withholdings you have also, and then divide the balance by 4. So let's say that you have income is fluctuating from year to year, and then a lot of your income is earned not at the beginning but the end of the year. That means possibly in the earlier quarters, you may be able to pay a smaller estimated tax payment. And then the last quarter, notice it's really after the year is over, you can make that big payment for the large income you earn in the later part of the year. In that case, what you can do is do an annualized income calculation. So for each quarter, you would estimate the income and then expand it out to a whole year, figure out the tax, and pay a quarterly tax based on that annualized income. Or then maybe estimate it for the first half of the year. It really goes out to 5 months only. You analyze it and then figure out how much taxes should have been paid for this first 5 months, and so forth. Okay, so that's done with a form. Let's take a look at the form called 2210. And this is really to do a couple different things. It helps you calculate if you have an exception to, again, the late payment of estimated tax penalty, or it helps you calculate the penalty. And again, you don't really need to do anything to calculate the penalty if you want the government to bill you. But if you think there's an exception to the penalty or an exception to reduce the penalty, you got to file this 2210 form. And the form is 4 pages long. What you're looking at is just the first page. And the instructions to this form is 12 pages long. So it's not the simplest thing to fill out. So that's where you want to use tax software. But let's kind of zoom in here and take a look again at those exceptions we just saw. So if you remember, if your total taxes due is under 1,000, there's no penalty. But the way you would calculate that is to take a look at the income taxes you have for the year, and you add other taxes for the year. That includes the self-employment tax we had seen a few chapters ago, and some other miscellaneous taxes. And you can minus out refundable credits. Those are like the child tax credit, earned income credit, part of the education credits. And then the total of all of that would be the current year tax you have to have paid. And if it's less than $1,000 still due, then it says here you can stop because you meet one of the exceptions to the penalty. You just pay that balance with your you pay your balance of taxes due when you file your return. Another exception is to take 90% of the current year's taxes, and as long as you made timely withholdings during the year and timely estimated payments during the year, that is at least 90% of the tax, then again, you don't owe a penalty. Or you can look at last year's tax, the prior year tax, and as long as you pay that same amount during the year through withholdings and through timely estimates, then you don't owe a penalty. But keep in mind again, if your AGI last year was 150,000 or more, then that prior year tax should be 110%, not 100%. And if you want to do some other exceptions like that annualized income, then you have to keep on going to other sheets in this Form 2210. Okay, let's take a look at the 1040 form. And here you can see really page 2 of that form. This is the 2019, page 2. And for most people, whenever they have an overpayment, they want to get it back as a refund. So they do this direct deposit information here so they can get back their refund real fast. But if you know you have to pay estimated tax payments for next year, instead of getting a refund, what you should do is take that overpayment and apply it to next year's estimated tax payments. At least enough apply to next year to cover the first quarter's payment. And if you still have any extra, maybe then you want to have that refunded. Or you can have the whole thing applied to next year so you don't have to waste time maybe making those quarterly estimated payments. So maybe this applied to next year is enough to cover the first quarter. If not, you got to make up the balance by the first quarter. Again, that's April 15th and June 15th for the second quarter and so forth. So how do you make these payments? Well, if you're going to mail in your payment, you're going to be using this form called 1040ES. And you can see there's going to be at least 4 different so-called vouchers. This one is due by that first quarter, April 15th deadline. And you would just enter the dollar amount here and write a check to the United States Treasury, and there would be an address on the instruction. In fact, this 1040ES including instructions, is again another 12 pages long of information trying to have you calculate the amount of the estimated tax payments. But again, the simple way is to pay the same amount you had owed last year for the whole year, the whole annual tax liability, and dividing up that by 4, reducing it by any withholdings you have. And here you can see the second voucher due June 15th. The third is September 15th. And the fourth quarterly payment is due after the year's over, January 15th. Hawaii has similar forms. In fact, this one form has multiple uses. You would just enter the year here, and if it's for paying a balance due for the annual tax return, you would check off this bottom box. If it's a payment for estimated tax payments, here you can see you don't really need to identify the quarter because it'll just accept the date you had mailed it in as the date the payment was made. Now, more and more, what's getting popular is to pay through the tax software, debiting your bank account. And if you want to have even more control over your payments to the government, payment of taxes, what you can do is set up an account with the government. In the case of the federal income taxes, here there's a site called Electronic Federal Tax Payment System. This EFTPS.gov site, and you need to set up an account. Okay, it makes it much more convenient to pay taxes to the federal government. And the Hawaii government has a similar site here called Hawaii Tax Online. And again, you would have to set up an account and link it to a bank account. Okay, that's it for estimated tax payments. We'll have a few homework problems in trying to fill out or calculate the quarterly payments. Okay, go ahead and continue with the part 2 video covering retirement plans.